Welcome to The Explainer, where we break down big topics. Today, we're jumping into something pretty wild. Why some of the world's sharpest analysts are suddenly making these absolutely startling predictions about precious metals. And more importantly, what could it all mean for you? Okay, let's just dive right in with a quote that, honestly, it kind of gets right to the heart of the problem. This is from William White, the former chief economist at the Bank for International Settlements, and it really sets the stage for everything we're about to talk about. See, there's this growing fear out there, this idea that our usual economic safety nets, they might not be there for us next time. And that's why you're seeing investors everywhere scrambling to find a truly safe place to put their money. All right, so first up, let's get on the same page about the core problem. The thing that has everyone on edge. We're talking about that unavoidable cycle of economic recessions and, yeah, the warning signs that are flashing bright red right now. And look, this isn't just some guy's opinion on the internet. This chart, this is from the U.S. Federal Reserve's own model. It's all based on something called the yield curve, basically the difference in interest rates between short-term and long-term government debt. And here's the kicker. Just look at those gray bars. Every time that red line spikes up like that, well, history tells us a recession has been right around the corner. It's been a scarily accurate predictor. And this isn't just a U.S. story, not by a long shot. What this chart shows us is that the economic cooling is happening all over. This is Europe's manufacturing index, the PMI. The simple rule is anything below that 50 line means things are shrinking, not growing. And you can see it was already looking pretty weak even before all the recent global shocks. So when the whole world is slowing down at once, that search for a safe place to be, well, it gets a whole lot more urgent, doesn't it? Okay, so when things start heading south, what do investors usually do? They turn to their hedges, right? The things in their portfolio that are supposed to soften the blow. But here's the problem. The classic playbook, the one everyone's relied on for decades, it might be totally broken. For as long as most of us can remember, government bonds were the go-to safe asset. It was simple. Stocks go down, bonds go up. They balance each other out. But take a look at the future column. Things look different. After years of crazy low interest rates, there's just not much room for bonds to rally anymore. Plus, with global debt hitting all-time highs, the risk of companies and even countries defaulting is way higher. Suddenly, that classic, reliable hedge, yeah, it's not looking so reliable anymore. So, that brings us right to the million-dollar question, doesn't it? If the old safe harbors are springing leaks, where on earth do you turn? Where does the smart money go when the storm really starts to brew? Well, to find an answer, maybe we need to look back. Let's dig into the hard data and ask a simple question. How has gold, the original safe haven asset, actually done when stocks have taken a nosedive in the past? Okay, this chart is fascinating, seriously. Each one of those dots is a month where the stock market tanked, falling more than 7.5%. The blue bars are bonds, the gold bars are, well, gold. And here's the thing that just jumps out at you. In a whopping 87.5% of those really bad months for stocks, either gold or bonds, or sometimes both, were in positive territory. They acted like a shock absorber, cushioning the blow. Now, let's slice it a different way. If you break a recession down into phases, the pattern gets even sharper. Just check out phase 3. That's when a recession is official, the absolute thick of it. On average, stocks got hammered, down over 10%. So what did gold do? It went up 20%. It's an almost perfect inverse relationship. The worse it got for stocks, the better gold seemed to do. This is another cool way to look at it. This line is basically asking, how many ounces of gold does it take to buy the S&P 500? When the line goes down, it means gold is getting more valuable compared to stocks. And just look at that massive cliff dive during the 2008 financial crisis. It's just a crystal clear picture of how time and time again, gold has been a powerhouse strategy when a crisis hits. All right, so the history is pretty clear, right? Gold has been the hero of the story more than once. But what happens now? What happens when you take that historical performance and you throw it into the crazy mix of economic pressures we're facing today? This is where things get a little wild. Some analysts are painting this incredibly dramatic, almost prophetic picture for the next few years. So let's take a look at the actual forecasts they're making for 2026. And I'm just going to give you a heads up. You might want to sit down for these numbers. First up, you've got strategist Tom Bradshaw. He's warning that the way gold has been behaving lately is a classic signal of a really deep crisis on the horizon. And his forecast, based on his models of monetary chaos, a potential price of, wait for it, $9,000 an ounce. And if you think that's crazy, his call for silver is even more extreme. He's looking at the unique dynamics of that market and predicting a potential surge all the way up to $375 an ounce by 2028. Okay, so maybe that's just one guy, right? Well, what about the major banks? They're a little more conservative, but honestly, not by much. Look at these targets. Goldman Sachs, JP Morgan, Bank of America, they are all pointing to a gold price right around $5,000 an ounce. Let that sink in. These aren't just some fringe commentators. These are literally the biggest names in finance. And at the same time, you've got this whole chorus of famous investors making their own really bold predictions for silver. You've got Peter Schiff, Robert Kiyosaki, Mike Maloney, and they're all talking about prices from $100 to $200 or even higher. And they all have the same reason. They see it as an absolutely critical investment for the next big market crash. So you have to ask yourself, what in the world is behind these absolutely massive predictions? Is it all just fear and hype? Well, it turns out it's actually a really powerful 1-2 punch. You've got the classic geopolitical fear on one side and brand new fundamental demand on the other. The first driver is that classic flight to safety we talked about. It's a simple reflex. When things get chaotic and uncertain in the world, trade wars, conflicts, that kind of thing, investors get scared. They sell risky stuff and they run to things they see as safe. And for, literally centuries, gold and silver have been the definition of a safe haven asset. But for silver, there's a whole other chapter to the story. And this is really important. It's not just money. It's a critical industrial metal. Think about it. It's absolutely essential for the AI and data center boom. It's a key ingredient in every single solar panel. And it's used all over the defense industry. All of this new industrial demand is creating what's called a structural supply deficit. And that's just a fancy way of saying the world is using up more silver than we can pull out of the ground year after year. So when you put it all together, the history, the shaky future, these just wild predictions, it leaves us with a really provocative final question. What role do these ancient metals really play in our super modern digital economy? So let's bring it all home. Are these predictions of $5,000 gold just prophecy? Or are they pure fantasy? No matter what you believe, the data doesn't lie. In every crisis, investors look for an anchor to hold on to. And that really forces us all to ask a tough question. What will that anchor be the next time things go sideways? And will you be ready for it?